Have you ever watched a stock just take off, completely miss the boat, and then just stared at the chart wondering, okay, where do I buy the dip? Well, today we're going to pull back the curtain on a tool that's designed to answer that exact question, Fibonacci Retracement. We'll break down exactly how you can use it to find those high-probability entry and exit points with a whole lot more confidence.
So, let's set the scene. A stock is in a massive uptrend, but you missed the initial launch. You know the classic advice is to buy the dip, right? But where is the dip? Where is that perfect spot to jump in before it takes off again? That's the million-dollar question we're going to tackle right now.
Okay, here's our game plan. We're going to start with the basics, what Fibonacci even is. Then we'll get into the key levels you absolutely need to know. After that, we'll get practical. I'll show you how to draw the tool, build a solid trading plan with it, and, super importantly, how to avoid the common mistakes that trip people up. And you're definitely going to want to stick around for the end, because I'm sharing the single most important rule for making this tool work for you.
So, first things first, what in the world is Fibonacci? Well, long before it was a trader's best friend, it was actually a mathematical sequence from way back in the 13th century. It's kind of wild how these ancient numbers became such a huge part of modern stock charts.
Okay, so what does that actually mean for us traders? In plain English, the Fibonacci retracement tool is like a roadmap for pullbacks. It helps us pinpoint these hidden zones where a stock's price might hit the brakes, turn around, and rejoin the main trend. It's not a crystal ball, but it's all about finding high-probability areas for potential support and resistance.
Now, this is where the magic really happens. The whole tool is built around a specific set of percentage levels. And these are not just random numbers, you guys. They're all derived from that original Fibonacci sequence, and they're watched by millions of traders all over the world. These are the big ones you'll see on your chart. Think of them as potential floors where the price might bounce. A quick dip to the 23.6% level, that's actually super bullish. It means the trend is incredibly strong. The 38.2% and 50% levels are way more common spots for the price to just catch its breath. And that 50% level, it's not technically a Fibonacci number, but it's a huge psychological line in the sand. It's the halfway point. But the real star of the show is up next. And here it is, the big one. The 61.8% level, also known as the golden ratio. This is the heart and soul of the tool. Why? Because this ratio shows up everywhere, not just in the markets, but in nature, in art, all over the place. So when a price pulls back to this level and bounces, it's a massive signal that the big money players are stepping in to defend that trend.
So we know what it is, we know what the levels mean, but how do we actually get this thing on a chart? Don't worry, it's way easier than it sounds, and it just depends on one simple thing. Which way is the market going?
It's super simple, really. If you've got an uptrend, you find the last major bottom. We call that the swing low. You click, and you drag your mouse all the way up to the recent top, the swing high. Boom, the levels pop up below the price, showing you all those potential support zones. For a downtrend, you just do the exact opposite. Click the swing high and drag it down to the swing low. Now your levels show up above the price as potential resistance. Easy as that.
All right, this is where the rubber meets the road. I mean, knowing how to draw lines is cool and all, but knowing how to actually make money off them, that's the whole point, right? So let's build a simple step-by-step plan you can actually use.
Look, a solid plan is everything. First, you've got to make sure you're actually in an uptrend. Second, you have to be patient and wait for the price to pull back into that sweet spot, the 38.2% to 61.8% zone. Third, and this is so important, don't just blindly buy the second it touches a line. Wait for proof that buyers are showing up, like a strong bullish candle. And finally, for extra confidence, look for another indicator, like a spike in volume, to back up your decision.
This right here is a huge takeaway. While a stock can bounce from any level, this zone between 38.2% and 61.8% is what traders call the golden pocket, or the buy zone. Think of it as the optimal discount area, where buyers are most likely to get interested and jump back in to push the price higher.
You can't take a trade without knowing exactly where you're getting out, for a profit or a loss. The Fibonacci levels give you a logical place for your stop loss. A great spot is just below that key 61.8% level. If the price breaks that, the trend might be in trouble. And for your target, the simplest place to aim for is the previous high, right where the pullback started. Now you have a full plan, your entry, your exit, and your target.
Now listen, as powerful as this tool is, it is not a magic wand. A ton of beginners make the same predictable mistakes that end up costing them. So let's talk about what they are, so you can just not do them.
The biggest mistake, by far, is trying to slap a Fibonacci tool on a chart that's just going sideways, doing nothing. Remember, it's a trend-following tool. Another classic error is trading every single line. Price hits the 23.6, buy. Price hits the 38.2, buy. That's a recipe for disaster. And finally, ignoring volume is a huge mistake. A bounce is way more believable if there's a big surge of volume behind it.
So what's the pro move? It's a concept called confluence. It sounds fancy, but the idea is simple. You want to find spots on the chart where multiple signals are all pointing to the same thing. For example, what if the 61.8% level lines up perfectly with a major trend line? Or what if an indicator is showing the stock is oversold right at that same spot? When you get 2 or 3 reasons to take a trade, your odds of success go way, way up.
We have covered a ton of ground, but if you only remember one single thing from this entire explainer, I really want it to be this. This is the one rule that truly separates the amateurs from the pros.
That's it. So simple but so powerful. The trend is your friend. Before you even think about clicking that Fibonacci tool, your #1 job is to find a strong, obvious trend. This tool measures pullbacks inside of a trend. If there's no trend, there's nothing to measure, and you shouldn't be trading it. It really is that simple.
Okay, let's bring it all home. Let's boil everything we just talked about down to the key takeaways that you can start using right away. So remember these 3 things. 1. Use Fibonacci to find those key support and resistance zones when a stock is pulling back. 2. Use those levels to build a complete trading plan, your entry, your stop, and your target. And 3, most important of all, always, always, always start by making sure you're in a clear, established trend.
So there you have it. The power is officially in your hands. You've got the tool, you've got the rules. The next step is to open up those charts and start putting it to work. So the only question left is, what's the first trend you're going to analyze? Go find it.